Consider the math of a modern mortgage. You lock in a massive financial liability that takes 25 years to pay off. But to service that immovable, multi-decade debt, you rely on a university degree, an asset that, in today's market, practically burns to ash the moment you walk off the graduation stage. This visualization shows the exact scale of the crisis Canadian households faced entering 2026. The aggregate credit market debt surpassed $3.2 trillion. When measured against what people actually earn, the debt-to-disposable income ratio hit 177.2%. That means for every single dollar of disposable income a household takes in, they owe $1.77 to the credit market. Watch how the internal mechanics of this debt adjust. The Bank of Canada gradually lowered interest rates down to 2.25%, which should have given borrowers cash flow relief. It didn't. As variable rate mortgages renewed, banks aggressively enforced catch-up payments to cover negative amortization. The interest portion shrank slightly, but the principal obligation block expanded, entirely neutralizing the benefit of the rate cut. Servicing these massive monthly payments requires steady, predictable wage growth, but the modern labor market is experiencing something called skill rot. With the exponential advancement of generative AI, the shelf life of highly specialized technical skills is now measured in months. The market aggressively devalues these proficiencies every year and a half, rendering traditional four-year curricula outdated well before graduation day. Because technical credentials expire every 18 months, the cost of continuous reskilling acts as a constant, hidden tax on discretionary income. When this persistent drain on personal capital is paired with rising contractual principal obligations, the household enters a cycle of liquidity exhaustion. Eventually, the cost of maintaining professional relevance and servicing fixed debt outpaces the capacity to generate new wages. The institutions overseeing this financial ecosystem are actively observing a shift in how Canadians attempt to survive this wage stagnation. Because young professionals cannot clear strict mortgage stress tests using their decaying income potential alone, they are turning to external leverage. They are utilizing the home equity of their parents to qualify for homes they cannot afford on paper. Households 55 and older expanded their mortgage debt by 6% in late 2025, aggressively tethering debt to their children as backstops. If a younger borrower's skills fall behind the AI curve, their job loss triggers a cascading default, instantly draining equity from co-signing parents. This intergenerational tethering transforms individual credit risks into systemic ones. A single localized employment shock now pulls multiple households into the default process simultaneously, exposing the broader banking system to a chain reaction of insolvency. This household fragility collides directly with a broken physical supply chain. The Canadian construction sector relies on delivering high-density projects into major urban centers. In 2025, that model froze. Investors abandoned the pre-construction market because the math of carrying a unit no longer made sense. New condo sales in Toronto plummeted 92% below the 10-year average. To salvage stalled pipelines and avoid bankruptcy, developers abruptly canceled their condo launches and pivoted thousands of units into purpose-built rental apartments. You might see headlines about asking rents falling by 7.9% in Vancouver, but that is a temporary illusion. Economists call this a supply echo.
Investors who purchased pre-construction units years ago are finally taking possession, realizing they can't afford the current holding costs, and simultaneously dumping their units onto the secondary rental market. While the domestic supply chain attempts to correct itself, international variables are forcing costs higher. Friction in the Middle East sparked a sudden energy shock. Domestic gasoline prices surged 26.1% year-over-year, immediately dragging the national inflation rate back up. Simultaneously, the threat of new U.S. trade tariffs injected extreme volatility into global sovereign bond markets. Because Canadian 5-year fixed mortgages are priced directly against those bond yields, borrowing costs surged regardless of what the local housing market actually needed to survive. By importing inflation at the gas pump and importing bond market volatility from across the border, domestic affordability was completely detached from domestic policy. The central bank's ability to seamlessly stimulate the housing market evaporated. A housing start only confirms what was funded and permitted years prior. The current absolute lack of building permits and condo launches creates a structural lag that will physically manifest as a supply cliff in 2027, as those unbuilt units fail to reach the market. Once the current oversupply of older investor units is absorbed, the market hits a wall. When interest rates eventually ease and sideline buyers return in 2027 and 2028, that returning demand will violently collide with an absolute void of completed supply, triggering a massive secondary affordability squeeze. Navigating this environment requires abandoning the concept of a finished education. You can no longer act as a static degree holder. To maintain the income required to solide the coming supply vacuum, professionals are transitioning to an active learning model, treating their knowledge base like software that requires weekly patches and aggressive updates. The modern economy strictly rewards human-centric meta-skills. Capabilities like cross-disciplinary synthesis, strategic intuition, and advanced prompt engineering remain highly insulated from automation. They are the tools that allow workers to actively pivot and monetize new technologies the moment they emerge. A static credential is now a sunk cost in a high-frequency economy. When you are trapped between multi-decade debt obligations and global inflation shocks, cognitive agility and a track record of continuous reskilling become the only reliable defenses against falling behind.